Welcome to another episode for Zenith Retirement's network here. We're talking about today wealth management, but specifically for Zenith Retirement, the services we offer, the investment consulting we offer, and the advanced planning services. Before we get started, I'm Robert Martin. I'm a chartered financial consultant, and I'm also a partner here at Zenith Retirement Planning. So with that said, let's get started. When we're talking about wealth management here at Zenith, the way we consider things are as if we're embarking to construct a building together. And this building is going to be established or built on Charles Schwab land. Charles Schwab is a custodian, or in other words, it's a bank that holds money. And so you always have your accounts at Charles Schwab, never directly with us. And you can do anything with that account. You can have checks or a debit card. It's just like a bank. The difference is you're going to get a special code that lets Charles Schwab know that you're with us. It waives all fees, and you only pay our advisor fee, which is between 0.5 and 1.5%. Now, when we're going to build the building together that's on Charles Schwab land, we always start with the foundation of the building. The foundation is the most important part because if it's not established correctly, it can be very expensive to fix later. And there are several parts we look at. The first thing that we look at is going to be cash. How much cash you have available is extremely important because if you don't have enough cash sitting in the bank for your needs, two things happen. One, you're either depending on fixed income every month to replenish your cash availability, whether that's pensions or Social Security or an annuity, or you're relying on the performance of the stock market, and if you need money, you have to go into your portfolio, sell some investments, and gather that. But the problem with that is if the market's down, you're going to have to take your money from a down portfolio and simply accelerate the depletion of your money. So we always recommend having 6 to 12 months worth of expenses sitting in the bank. The other thing we consider is your income. Now, you either get your income from your cash reserves or you get your income from your stock market portfolio, which we'll get into. But what we do here is we want to make sure that between Social Security, pensions, annuities, that your fixed income sources are more than your expenses. Because if they're not, then you have to go into your cash or go into your portfolio. This section right here is very important. This is your current investments. If you're not currently a client of Zenith Retirement, just because you have a portfolio now and we offer our own selection of investments doesn't mean we want to change what you're in. If what you're in is working for you, then we actually want to keep those investments and simply replace those that are not working for you. So if this top part's the investments, we're going to take your current investments and compare them side by side with what we offer. Now the last part here, and probably the cornerstone, one of the most important parts of the foundation, is the advanced planning. And this is making sure that you have a tax team that helps you with year-to-year tax planning so that around tax time you don't have to worry about it. So that you know you're taking advantage of opportunities to save you money and you're avoiding harm or tax law changes that could cost you money. Also, estate planning is extremely important, making sure that you're leaving your legacy exactly as you want to leave your legacy. To make sure that your money enhances the lives and the well-being of your family instead of taking away from it. The other part here is charity planning, magnifying what you give charitably so that you can save the most money tax-wise too and put it back in your pocket. And then also Medicare, making sure that you don't make the wrong choice with your Medicare options. Now here at Zenith, we have a network of CPAs, estate planning professionals, a Medicare specialist, and even charitable planning experts at Charles Schwab that all work with us here at Zenith Retirement inside the same building as us, inside the same office as us, to make sure that you're taking advantage holistically of everything. Now with that said, the top part is the investment part. And there are four parts to how you invest, starting with what we'll call the aggressive growth part of your portfolio, which is this part here. If you consider the top floor of your house, you may not think of it immediately, but it is your attic. And your attic gets the hottest, it also gets the coldest sometimes. In the aggressive growth portion of a portfolio, we aim to do two things. One is to outpace inflation. And second is to provide a hedge against long-term care in case you have to self-fund, you don't have long-term care insurance. This is where you're going to grow your money so that you can potentially afford it. And there are three areas that we look at. The first one is disruptive growth. Areas like genomics, cybersecurity, technology, things that have led growth over the last 10 years and will be continuing to lead growth. This part here is what we call our beach portfolio. However, every couple years we change this portfolio because there are specialty portfolios that are time contingent. So beach stands for bookings, entertainment, airlines, cruises, hotels. If you consider back in 2020 when the pandemic hit us, no one was traveling as much. No one was going on cruises or going to foreign countries or booking hotels or going to the beach as much. And so in the last 3 years, those industries have really blossomed again because people have continued to do that. And the last one here, commodities. Things like gold, precious metals. We even have some alternatives in there. But we don't just simply buy and sell oil and gold at strategic prices. We can actually set parameters so that you have 30 points of protection on the downside of gold, for example. And if the price decreases by, let's say, 30%, you don't lose anything. If it decreases by 31%, you just lose 1%. So 30% of protection. And on the upside, you'll be capped because of that really good protection. You're going to be capped at about 8% of growth. So that is our aggressive growth, and we always use ETFs here because they're the most inexpensive. The next part here is what we're going to call diversified growth. And this is not quite as aggressive growth. And here we do two things. And here we use 100 plus different models through 7 or 8 different money managers that we're able to use on the institutional side, which means we get all their investments at a cheaper rate than you can buy yourself because we have $1.5 billion in assets that we manage. All these models have a speed limit, the same way you have a speed limit. For example, if your portfolio, the risk, we measured it between 1 and 100, you may not be comfortable going more than 30 miles per hour in retirement. Likewise, somebody else may be comfortable going 80 miles per hour. It's all dependent on you. Well, we match you to a model that has a speed limit as well. When I say model, I mean an investment philosophy. So one of these models might say, we want to buy investments that are undervalued, but if we look at their company records, if we look at their statistics, they're a really good company. And we want to buy just those companies. In fact, we're going to buy 7 or 8 investments for that portfolio. That's a model. Now that's one amongst 100 of them. Over here, we use custom ETFs. Because we have the money under management, we can create an ETF that's specifically for you and set parameters around it. For example, if the market goes down 30%, let's say the S&P, you don't lose anything. But if it goes down 31, you lose that 1%. Same thing as up here. You have 30 points of protection. And on the upside, you can get 8%. But we can change that. You can change it to be down 15, up 15. Depends on what you want to accomplish. The next portion here is what we consider income. Here, 2 more things. We use good old-fashioned dividend-paying stocks and ETFs. We even use some bonds here. And over here we have barrier notes. Now, barrier notes are very similar to the custom ETF where you have protection on the downside, But the catch is, okay, as long as the market doesn't go down more than 30%, you're guaranteed to get a coupon, a 10% coupon paid monthly to you. But if the market goes down more than 30%, you simply don't get your coupon. Okay. This is a favorite for clients who want to maximize the return on their money with the least amount of money possible. So with that said, then we have the last part here, which we're going to call safety of principal, or in other words, security. And there's three things that happen here. The first thing, there are no fees. There's no risk. And it's creditor protected. The first area here are MYGA, multi-year guaranteed annuities. They're actually one of the least popular investments right now because agents don't like to sell them because the commission is very small. It's actually the smallest in the industry, but the rates are competitive with any bond you can buy right now as of 2023, where some bonds are paying as high as 4 or 5%. Same thing with the MYGA. It's basically a CD offered through an insurance carrier, and they have 3-year and 5-year terms. Over here we have indexing through an insurance carrier where you have a 0% floor, so you can't lose any money, but you can make up to 8%. That's what we use for security. Now, dependent on your risk tolerance, your objectives, you're going to be blended throughout these, not just in one section. With that said, ladies and gentlemen, it's always a pleasure to speak with you, and please stay tuned for the next episode. If you want to be alerted when the next episode comes out, please hit that subscribe button. And if you want to leave some feedback, drop a comment or give us a thumbs up because you loved it, or give us a thumbs down because you didn't like it. Regardless, it's always a pleasure and look forward to seeing you, or at least being able to speak to you on the next one.